Welcome grade 12s, yes, to your favorite learning channel, Matrix Uploaded, the channel that ensures that you get the best results in accounting. Okay, what are we looking at today? Today we're looking at the recording of fixed assets. That's right, a section that often poses challenges to our matriculants. So what do? This is what we do. Let's go through it. Number one, whenever we are purchasing fixed assets, how can they be purchased? Either we purchase for cash, and when that happens, we are debiting the asset account and we are crediting bank. And if we buy on credit, then what happens? Very simple. We are again debiting the asset account, but we are then crediting creditors control. Okay, so that's just the two ways in which we purchase an asset. Now, that asset, when you bought it or when we buy it, is subject to something that we call depreciation. And what is depreciation? Depreciation is what we call an imputed expense. What do we mean by that? By that we mean it's an expense that does not affect the flow of funds. In other words, guys, no money is changing hands, but yet it's an expense to us. Why? Because the asset is losing value. That's what depreciation is all about. Okay. Methods of depreciation. Remember, we have what is called the fixed installment method, okay, which is the cost price times the rate. Okay, that's that one there. Or you could have the diminishing balance method, which is the cost price minus the accumulated depreciation times the rate. So the fixed installment method is also known as the straight line method or the fixed installment method, or they could tell you to calculate depreciation on the cost price. The other one, you could be asked to calculate depreciation on the diminishing balance method or the reducing balance method, or you may be asked to calculate depreciation on the book value. In that case, we are using the second method of depreciation. Let's carry on further. In both instances, immaterial of which method you are using, what is your double entry? Here goes. A debit to depreciation. Why? You should be screaming out the answer, because depreciation is an expense. It reduces the equity of the business, therefore debited, and you would credit accumulated depreciation. Why? Because accumulated depreciation is what we call a negative asset. What does it do? It reduces the value of your asset. In other words, it's that part of the asset that has been used up already. Let's carry on. If depreciation needs to be calculated for a portion of the financial year, then you also have to bring in the third component. And what do we use here? Watch this here. Watch it closely. This is what we do. We calculate art. What am I talking about? Am I talking about drawing your accounting teacher? Certainly not. I am referring to an acronym for amount, the rate, and the time. That's right. Let me repeat that because of its importance. You take the amount that you are calculating. Now, obviously, if it's on fixed installment on the fixed installment method, you'd be using your cost price. If you are using your diminishing balance method, you'd be working on your carrying value or your book value. So that's what we regard as the amount, that is that component. Okay, number two. You now calculate the rate of depreciation. In other words, in this component here, what are you going to be doing? You're going to be specifying the percentage. Is it 20 over 100 or 10 over 100, depending on whatever it may be? That is the rate of the depreciation. And then the third component, the time component, a very important component of your calculation. Why? Because it is this component that will specify to you. Therefore, I'm going to use X004 over 12. What does this mean? This means that this will tell you how many months that you have used the asset. In other words, matriculants, what are we saying? We are saying that if you are disposing of an asset during a financial year, in other words, you're not using the asset for the entire year, in that case, you would indicate the number of months that you have utilized the asset in this part of your calculation, the time component. And here, remember, you're going to specify the number of months. In other words, it could be 1 over 12, 2 over 12, 3 over 12, any component. And this is what we regard as pro rata depreciation. Okay, guys, what have we done? In this initial segment, we have spoken about the purchase of the fixed asset in terms of how we're going to be buying it. Secondly, we spoke about the recording of the entry. In both cases, you are debiting the asset and crediting bank or a credit to creditor's control, depending on how the asset has been purchased. And then we went on to an important consideration regarding assets, namely the depreciation. Okay? At this stage, you know that depreciation is an imputed expense, which is going to tie in with work which we're going to do later on in the year. What are we talking about? An imputed expense, an expense that does not affect the flow of funds. Okay, and there finally we spoke about art. So there you've got it. Stay with us. Don't go away. We'll be back in a jiffy.